E agora a gente vai abordar um tema muito relevante na carteira dos nossos clientes e também muito desafiador e que vem gerando um grande debate entre gestores locais e internacionais. Agora a gente vai falar sobre gestão de renda variável em um cenário de taxas de juros altas. Para participar desse painel, gostaria de convidar ao palco o Richard Claude, Portfolio Manager na Janus Henderson, Fabiana Arana, sócia do BTG, para moderar o painel, e também Gregor Andrade, diretor global da gestora AQR.
Eu só pergunto se esperamos 2h15, que é a hora do painel, ou se a gente pode começar. Vamos embora. Bom, boa tarde. I think we are going to switch to English. Yeah. Good afternoon. You know, it's a great pleasure to be here with Richard and Gregor. I would like to thank you both for the partnership with BTG Pactual. Thank you, Will, Laura, and all my colleagues for the invitation. And thank you all for being here, listening to us today. Well, a lot has been said about tech, US tech, artificial intelligence, and all these developments have been dominating the equity space, right? So I'll start with Gregor. What has been the impact of the current machine learning and all this AI in your process, in your portfolio, please?
Thank you. So I think it's important first to establish that we are a quantitative manager by design. AQR stands for Applied Quantitative Research. That's the name of the company. So the word quantitative. So we have always relied on technology and science and systematic approaches to investing. So in that sense, we kind of feel like the recent developments in AI and machine learning and language models and all that are an opportunity to continue to evolve something that we've already been doing for a long time, which is investing systematically. So the first thing to say is we believe that machine learning and AI is an evolution, not a revolution in the way we invest and the way we think folks can invest. There's a couple of challenges with using some of the machine learning and AI techniques that are unique to finance, to financial markets, which make financial markets different from other applications like in natural science or in imaging or facial recognition, pattern recognition. Financial markets have a characteristic that they evolve, they change, because the actors in financial markets are individuals that can learn. And so unlike in the real world, in nature, when people learn about something, it then changes the prices of the assets because they trade on that information. And so it can be difficult. It's a much more difficult problem for any kind of technical modeling to model a system that is constantly changing and learning and evolving. So that's one challenge. The other challenge is that financial markets have what we call very low signal-to-noise ratio. There's a lot of noise in markets. A lot of the volatility and the movements in prices are not driven by news, they're often driven by noise. And so it can be also challenging for machine learning to extract as much value from financial markets as they can perhaps in other more scientific applications. So that's just to say that it's a challenging problem. At AQR, we use machine learning for three things. They're each classical problems of quantitative investing. When you're a quantitative investor, you have to do one of three things. You have to choose indicators or signals to evaluate investments. You have to then decide how to combine those signals in a model, and then you have to decide how to change those signals over time. And we find that machine learning can be used for all three. So you can use machine learning to help build new signals. So we've done work, for example, using language models and natural language processing to be able to read news and articles and information and extract sentiment from that in a way that we think is very efficient. We've also are building techniques to use machine learning to help us time some of our signals. So when is something more in favor, when is something more out of favor? And then finally, the problem of how do you combine. Our models have hundreds and hundreds of signals, and you have to decide how to combine them, how to weigh them. We also find that machine learning can give a different answer than traditional techniques. So we're using it everywhere, but again, we think it's going to be an evolution, not a revolution.
I think it's important to, to make it clear that Gregor is Quant, and that Richard, he's responsible for, he's part of the global technology, one of the global technology leaders in Janus. And so we have two different specialists here in equities for a long time. And I'm Fabiana Arana. I'm also in equities for more than 20 years, first in the buy side and now in the sell side for BTG. So it's a little bit more clear who is here, right? So now I'm going to shift to Richard and to talk a little bit about China. So how do you see the investments in technology in emerging markets, as well as the positioning of the Chinese the players after the pandemic, Do you think there is a space for further ecosystems to be created in all the regions?
So, what we saw in the internet era, so, 20 years in equities, 20 years in equities dominated by one technology, the internet, dominated by one group of companies, the FANG, and quite honestly, you didn't really have to do anything else. And if you think about the opportunities, that they were in the US, but they were also in China. Some great Chinese internet companies until a bit more recently. And you could access that, and there was plenty of investments you could make in China. I first went to China to invest in internet companies in 2004. I think the first two investments I ever made were Ctrip and NetEase. That's not going to be the case in an AI world. And that's because of geopolitics. So, I met Tencent last week. They get a chip from NVIDIA that's half as good as the one that Microsoft gets or Google gets. And next year, it will be 10 times worse. The year after that, it will be 50 times worse. Within 5 years, you probably end up with a chip that's 500 times worse. And you think about the impact for that, Microsoft will be able to train a model in a day that's going to take Tencent 500 days. Now, if I'm a global investor and I want to invest in the leading AI innovation, I'm not going to want to invest in a Chinese AI company, am I? And that's obviously the stated goal of the US government. So, that's not going to change. It doesn't change if it's Biden or Trump in the White House. So my opportunity set as an AI investor in China is a lot more limited. Now, because of geopolitics, there will be other ecosystems that move to China and become localized. So, we already saw that in the internet. We've pretty much seen that in smartphones. We're pretty much seeing that in EVs. They'll try and localize everything in semis outside of leading edge and the AI stuff. But, my opportunity set's going to be a lot less. And, I know you're going to ask me a lot of questions today, but I just want you all to have one question in the back of your mind, which is, Brazilian clients have no exposure to this. I mean, this isn't just a China AI problem. Brazilian clients already made a bet, enforced because of their kind of restraints on international exposure or not, but they've already made a bet that this AI thing isn't going to work, that these AI stocks aren't going to keep going up. That's the bet that they've made. So the one question I'd like you to have in the back of your mind is, what if that's wrong? What are you going to do about it? What are you going to do with that international equity exposure that you do have? Because unless you do something pretty radical, the same thing that just happened in the last 20 years of significant outperformance of US equities and tech versus everything in Brazil, same thing's going to happen in the next 10 years. So just please have that question in the back of your mind.
No, this is really important, right? Because you look into those, Mag 7 stocks, and you say it's expensive, right? Do I still have upside? Do I have? No, people ask that question every single day, right? But we are going to talk about that. I will go back to Gregor. What is your view on the global, the current macro scenario affecting equities in general? And why I say that? Rates are high, and the S&P are on its highs. How to explain that? So
first, I should say, as a quantitative manager, we prefer not to discuss short-term views. I think it's, particularly for the room, maybe as an allocator, it's more important to think medium to long term. And our view is that medium to long term, the outlook for equities is below history. Not terrible, but below history. I'm talking about global equities. And there are really two things at play. One of them you already mentioned, which is that equities are very expensive. Global U.S. equity markets, global equity markets, developed markets at least. I think emerging markets are actually a little bit cheaper, but developed markets in general are expensive by historic standards. Part of that is because they've done so well, so we've benefited from that. If you've been in the market, you've benefited. If you haven't, you have not benefited. But that benefit has now means from a forward-looking perspective, P's are high. The previous panelists talked about this, the fact that equity valuations are quite high, which means forward-looking returns are low. So the other scenario is, for the first time, I think, since the financial crisis, we now have a lot of volatility. We went from a period of 2010 to 2020 where there was almost no volatility globally, and so that was a very Goldilocks period for equity investing. You had high returns, low volatility. Now we think you might have lower returns and higher volatility. So we're think that from an asset allocation perspective, it's an important time to look outside of equities. Previous panelists talked about fixed income, and I sympathize that there are some areas of fixed income that look attractive, but I also think that it's important for investors to look outside traditional asset classes like stocks and bonds and look at alternative investments, because alternative investments like hedge funds and multi-mercados have the capability of not depending on the market to make money, but of making bets and making investments that can bet against the market if they think the market's going to go down, or benefit from relative mispricings in markets. So we're advocating and talking to clients around the world about a greater need now for alternative investments in their portfolio versus the last 10 years where there was a tailwind that was helping, we think, bond and stock markets.
Interesting. Richard, do you want to comment on that? Rates high, S&P on its highs.
Yeah, look.
And maybe we can go to the valuation of the Magnificent Seven, you know. And I'm going to talk about that. We had a panel in our conference in February in the Hyatt with Scott Galloway, the AI guy from NYU. And one of the questions was, will the winners take it all, continue to take it all? Will the Mag 7 continue to take it all on the AI and on the investments, or we are going to have space for others?
Right, a bit to unpack there. I've been a technology investor for 21 years, and you can imagine every year I get asked the same question, valuations in tech. And the reason I get asked the same question every year is because the way people look at valuations for the technology sector doesn't work. Now, I believe that the rules of the stock market apply to tech as much as everyone else, but if you're trying to forecast the earnings of Coca-Cola, you can pretty much get it to the cent. In fact, if you look at the earnings revisions for Coca-Cola year to date, it's 0.8%. I don't know what consumer staple analysts do all day, because it's really not very hard. And that's why Warren Buffett loves Coca-Cola. If you look at the earnings revisions of technology companies, you mentioned the Mag 7. Tesla down 40% earnings revisions year to date. NVIDIA up 40% earnings revisions. Now, if you quote me a valuation, most people quote me a PE. And they quote me PEs as if PE is a fact. Now, the PE for Coca-Cola is a fact because the E is not moving, but the PE you quote me for NVIDIA's 18 months ago was completely wrong because the E was $5.80, and it turns out NVIDIA is actually going to do $25 this year. So, the denominator is a bit different, which means the stock was actually 5 times cheaper than you thought. In fact, actually, if you think about it, NVIDIA traded on the same valuation as Petrobras 18 months ago. Which one would you prefer to have bought? And that's why you've got to do your own work in the technology sector. It all comes back to profits. Is tech going to outperform or not? Is it a Mag 7 or not? Which company is going to earn and grow its profits more than any other companies or other sectors? Which companies already have that expected? And which companies are going to end up doing a lot more in the profits than the market currently expects? Because actually, those stocks are cheaper. The way you solve for the valuation eternal question in tech is to find companies that are going to earn a lot more profit than the market expects. They're actually a lot cheaper than the market expects. Value investing in tech doesn't work. So I think the tech sector is a very different sector when you've got to think about valuation, because that E really moves around. And I'll tell you, sell-side analysts in tech are about as good at predicting earnings as economists are at interest rates.
Good point. Gregor, would you like to comment on that, on the Mag 7, please?
I agreed with 90% of what you said, and you actually said that value works in tech if you do value correctly, and then you said value doesn't work in tech. So now I'm confused. I agree with you. The job of even a value investor is to find a company that's underpriced versus its profits. I think what you're saying is that traditional techniques like PEs maybe don't work, but valuation ultimately is about finding the mispriced asset, and you're identifying mispriced tech companies. I think the way we try to get around that problem at AQR, as a quant manager who ultimately is relying on data, and we're looking at thousands of stocks, we're not doing the detailed work that you're doing company by company, is by looking at peer groups. So in some sense, we're less concerned about whether tech is going to outperform consumer staples, and we're more concerned with trying to identify the companies within tech that are relatively underpriced relative to their potential. So I don't think the problem is actually that different. And there, some Magnificent Seven might be expensive, some might actually be cheap. It's all about how they're priced relative to how they will do in the future. And if you're comparing, I think, compared to the right peer group, you can still use value techniques within the right peer group, even if it's naive to compare a tech company to Coca-Cola. I agree with you completely, but within the peer group, I think the ideas are the same. You're trying to find mispriced companies.
And maybe one request. Can we never talk about the Mag 7 ever again? Because, I mean, it worked last year because basically everyone bought ETFs, and CNBC then coined it. If you want CNBC to be an investment strategist, I don't think you're probably going to be here in a few years' time because you're not going to be very good at your job. So, let's forget about that, because the Mag 7 have got nothing in common. They just happen to be big stocks that if everyone gets back into tech, having sold tech in 22, and buys an ETF, you're going to buy the mega caps. Now, year to date, there's a 200% relative return between the top Mag 7 and the guy at the bottom, and one's down 30%, one's up 170%. And why wouldn't that happen? Because they're completely different companies, do completely different things, have completely different AI positioning. Two have a business in China, some don't. Valuations, regulatory risk, completely different. So there's nothing that holds those stocks together. So why would you ever expect them to perform together? And again, reducing investing to just, a Mag 7, a nice acronym. As soon as you coin an acronym, you can pretty much guarantee they'll never outperform together again. It's not that easy. That's why we're all here in this room trying to figure it out.
Good point. The Mag 7 are mega caps, right? But what about small caps? Should we be thinking, about small caps now? On the tech set,
I think you've always
How do you see that?
I think you've always got to look for small caps. I've never been a believer that small caps are better than large caps or large caps are better than small caps. It depends. You want to buy the winner. Ultimately, the guy who's going to have those profits that are going to beat market expectations. It's not going to be the loser in an industry. The guy's the fifth guy that's losing share. It's going to be the winner. Now, if you end up winning in e-commerce or AI training, you're not going to be a small cap for very long because it's a massive market and you're the winner in that, you're going to be big. If you end up winning in our second best performing stocks in RFID, now RFID, great technology, but it's a niche. So if you end up winning there, you're going to be a small cap. So I just think that you want to have all opportunities, AI, non-AI, large cap, small cap, across US, globally, there are always opportunities, but you just got to be selective.
That was my question, The Mag 7 are mainly focused on US. What are the opportunities outside US?
So I think, a lot of the panelists have picked up another key one for us, which is deglobalization. So, there's several ways you can play that. One is, obviously we're building semiconductor fabs back in the US and in Europe for the first time in decades, so you can obviously play that. But the other one that we're seeing where actually you can buy tech companies on a single-digit PE, so value tech companies is companies like Jabil and Flextronics, contract manufacturers, because we had this kind of trend of globalization where you just outsourced everything to China. And those guys would have to compete with a Chinese supplier who would say, right, I'll just offer you cheaper price to Tesla or Johnson & Johnson or Apple or whoever it was. But now it's just much more complicated. You know, if you're selling a Tesla in China to a Chinese consumer, you've got to have supply chain and manufacturing in China. If you want to sell it in the European Union to avoid the tariffs, you're going to have to build that in the European Union. And the same, if you want to get IRA tax credits to buy your Tesla, you're going to have to produce that in NAFTA somewhere. So you've got to have manufacturing chains, you know, in the US, in Europe, and in China or Southeast Asia. There are not many companies that can provide that complexity and that scale of manufacturing. And so funnily enough, they can actually now charge for it, and they can make better margins. So, you know, some of our best stocks in the last few years have been around that deglobalization trend, whether that be semiconductor equipment names or actually just boring old contract manufacturers.
Interesting, thank you. Gregor, changing a little bit the subject, right? ESG, you know, it has really crossed, you know, the ocean and is becoming more important for Brazilian investors. What is your view, you know?
So for us, ESG has two dimensions. One is ultimately clients pay us to generate alpha or to outperform, but also they choose us products and have us build products that meet certain demand that they have for a certain benchmark, a certain risk. So we think of ESG along those two dimensions. On the alpha front, we have built some signals that we think that we've added to our alpha models that we think are ESG, particularly the G, so governance. So I think it's pretty intuitive that governance is a first order consideration for the long-term success of a company. A well-managed company with strong governance that will tend to outperform. So I would say G has always been part of our models. A little bit of ENS as well. So part of our research in ESG is just trying to identify data or signals that are ESG that we think help predict stocks returns. But the much bigger effort for us is really trying to meet a market demand. And you say about crossing the ocean, I'm actually, I'd be curious to see what is the evolution in Brazil. In the United States, if anything, we've seen it go the other way. 3 years ago, 4 years ago, I was much more optimistic that US investors were going to follow the European model and do more ESG. I would say today it's the exact opposite. ESG has become so politicized in the United States in a negative way that it's gone backwards. There are many places in the United States now where regulations and the laws do not allow you to do ESG for certain clients. So in North America, it's very much still very touchy subject. In Europe, though, it's very important. So what we've done is in Europe, we've developed versions of our strategies that we offer in Europe, which take our normal strategies and add some additional ESG consideration. So, for example, a stock model that in addition to looking for good companies, also tries to improve the ESG rating of the portfolio. So those are the two things we're trying to do. A little bit of identifying good ESG signals to pick stocks, but a lot of it is building products to satisfy demand, particularly from European investors, for strategies that have not only good alpha, but also positive ESG characteristics.
Thank you. Richard, ESG, any comments?
Yeah, I think just to be clear as to define what ESG is, I think people kind of conflate the terms ESG and sustainability, and that's what leads to a lot of the political debate. You know, for us, ESG is just looking at environmental, social, and governance risks. It's kind of how companies do things and conduct their business, in which case, you know, it's just fundamental to how you would assess a company. If you've got a founder-led company like you do in tech, often, and you're not looking at governance, you're not doing your job from a risk management point of view. If you have a consumer internet-facing company with a lot of consumer data and you're not looking at the social impacts and risks of what that company is doing, as we've seen live in the last 10 years, you know, you're not doing your job. A little less on the environmental side, but you know, data centers and semiconductor manufacturing is an area. Sustainability is more for us what companies are doing. So if you want to kind of make sustainable investments, you're thinking about what that company actually does, its product or service, its kind of purpose in life. So again, I think you want to be clear between the two. Now, I run a ESG integrated tech fund, so we were looking at the risks. I also run a sustainable tech fund, where we're actually trying to deliver companies that are actually doing something that we think is enabling a more sustainable future. Those for us are just two very different things, and I think they get confused in a lot of clients' minds.
Oh, this is perfect. Just because this AI trend, you know, are increasing the concerns on infrastructure, on the data center, the power consumption, right, that it's going to require. How can this concern be addressed in your view?
not by buying utilities or copper or cement companies, which is where I've seen a lot of fund managers get up on stage and say that's the investment opportunity. Look, I got shown exactly the same charts 20 years ago when there was this new technology called the internet, and boy, you were going to need a hell of a lot more data centers and we were going to run out of power. Well, the lights are still on. We didn't run out of power, and the reason why is, the forecast for 8 to 10% growth in power consumption ended up being more like 4, and the reason why is we ended up solving for it in the technology sector. So, I met TSMC the other day. They show you a chart where basically since the launch of the iPhone, they've reduced the amount of power per processing per square inch of transistors by 80 times in basically 15 years. And they're like, we'll do the same for AI. So, if you think about what NVIDIA is telling you, they actually show you a chart when they launched Blackwell. They say we can train a 1.8 trillion parameter large language model at 3% of the power of our chip 2 years ago, which was 4 years ago. So, we think that the way you solve for this is through innovation and through tech companies. So, gate-all-around transistors save you 30% power. Backside power delivery saves you 30% power. You can save power on your storage, on your networking. There's so many ways we can solve for this power issue, but most of that comes from innovation and from tech.
True. For you, I continue with you. What is the biggest risk, to technology sector? It's geopolitics, it's the Fed, it's elections. What is the main risk today?
I will answer the question, but again, I'll turn it around on you. The biggest risk for a Brazilian client is that tech keeps on going up and they don't have any of it. But I will answer your question. It's not geopolitics. It's not the Fed. It's not the elections. It's that, say something, AI doesn't deliver on its promises. We're all so excited we're going to get a Microsoft Copilot. It's going to do all our work for us. And actually, it's not that great. And the issue then will be the CFO is actually paying for all of this, $20 per enterprise user per month, is going to turn around and say, well, look, why are we spending all of this money on it? I'm not seeing any productivity boost. Our revenues, our profits aren't going up. And then they're going to turn around to Microsoft and say, I don't need any more seats. Microsoft doesn't grow. It turns around to NVIDIA and says, I don't need any more of your chips. That's how it's all going to come. The house of cards starts coming down. Now, we're not seeing any of that today, but is this going to be plain sailing? I've done tech long enough that, is it going to be beautifully all, aligned through the next 2, 3 years and this all gets deployed and everything's fantastic? No. And again, that's where we're going to have to dynamically assess the opportunities, the risks, expectations, valuations. And again, hopefully that's why you need us to be able to do that for you 24/7.
Just talking a little bit about flows. US tech has been the main competition for emerging markets. A lot of people are saying that nowadays, right? Do you agree? For both of you, the question is for both.
I think the main competition for emerging markets, frankly, and I'm thinking here about, I deal mostly with institutions in North America and globally. I think the main competition for emerging markets in the US and globally is private equity and private investments. The big trend that we've seen is for investors to reallocate away from small cap, emerging markets, and even active equities in general, and either go more passive equities and then spend their fee, their money, their time investing in private equity and private credit. And so purely from a business perspective, as I talk to clients around the world and I'm trying to get them to pay attention to hedge funds and to equity products, I see them saying, well, we only have so much budget to spend right now and to pay fees for our managers, and we'd rather spend that money signing on to more private equity and private credit than to do either hedge funds and I think the same thing for emerging markets. That's my opinion.
Yeah, I don't think it's about flows. I always think, investing comes back to profits or cash flow ultimately for anything you pretty much look at. And so, the areas of the market that are going to grow their profits more are going to do better. And, we always wait for this mythical, emerging market story where they're going to grow their profits faster than the rest of the world. And that just hasn't happened. And, I just don't think it ever will. And that's mainly because, the way that you actually access emerging market stocks, most of these indices are crammed full of oil companies and commodity companies and banks and telcos and utilities, and they're just not going to grow their profits as fast as many other areas, which are better represented in the US or in other places. So I think it's a sector allocation much more than a geographic allocation. And then the irony is that, I sell our tech fund globally, and yet the markets where, emerging markets, and I've actually put the UK and Australia in that, the places that are emerging markets, they then just go and buy international emerging markets. So, the places that don't buy tech are Brazil, South Africa, the UK, Australia, because they know their local market. They're used to oil companies and commodity companies and telcos and banks. They're used to PEs of single digit and under 10. And so when they then go internationally and go into the big wide world, they just buy more of the same. And actually, ironically, what they need to do is to really diversify into the thing they don't have, which is the other sectors, including technology.
It's interesting because Mexico, a few weeks ago, we just had a surprise on the elections, right? Mexico, everybody's talking about nearshoring and, expectation of earnings growth, as you said, buying equities there on the nearshoring expectation. And now, with this kind of unexpected surprise on elections, more towards the left side, people sold Mexico. And some of the jam guys were saying, okay, so we are might have some flow to Brazil. That so far has not happened yet. So it makes sense that probably this, this selling pressure and this flow went to the US tech that are growing, right? And that's as simple as that.
We manage emerging equity products, we manage global equity products, in addition to hedge funds, such as the ones we offer here through BTG. And there's been a huge decline in searches for emerging equity mandates. We see almost none. We talk to our clients, we ask them, how are you guys positioned in emerging markets? Most of them are reducing their weights. They are reducing their number of managers, either because they've been disappointed with the active returns or they've been disappointed with the beta, to your point, with just the overall returns in markets, and because they feel like the risk-return trade-off is better either in more attractive sectors like maybe tech or in other places like private equity where they feel like there's no volatility. They can make money with no risk. We think that's incredibly incorrect, but that is the perception. So it's just the reality. We've seen almost no search activity for emerging equity.
And maybe just one other point, you're generally told US equities are more expensive than the rest of the world. But actually in tech, they're not. And I think it's a really important point to make. If you're a Latin American fund, which Latin American fund doesn't own Mercado Libre? Which European fund doesn't own ASML? And because they all end up owning that one tech stock, they're valuation insensitive. So that tech stock ends up being way more expensive than its US counterparts. And Mercado Libre is way more expensive than even Amazon or a Meta or an Alphabet. ASML is much more expensive than Applied Materials or Lam. And so counterintuitively, in tech investing, we often go back to the US because it's cheaper, just because there's more choice.
Yes, with the speed, of the growth of the tech stocks, any risk in terms of supply chain? How do you see that,
Yeah, look, just over a year ago, NVIDIA, I've done semi-investing for 21 years. They put up a guide that was $4 billion above consensus, and I've never seen anything like that. I don't know who the supply chain guy is in NVIDIA, but he deserves like a prize. He's got some NVIDIA shares, he did get a prize. But I've never seen anything like that. And the reason why they were actually able to do it is, actually, if you think about it, they have 75% gross margin. They don't actually need to make that many chips, and they just sell them for a really high price. But also, it was happening during a semiconductor downturn. So everyone was falling over themselves. The one guy actually wanted some more. Yeah, sure, you can have it. Now, there's a shortage. Anyone who tells you NVIDIA or any of these other AI semis isn't ultimately cyclical hasn't done semis for very long. So, there will be an air pocket at some point. Doesn't look like it's going to be anytime soon. But, again, that's why we wouldn't look at 5 years out for an earnings number for NVIDIA, because we know at some point they'll have a downturn. So, the biggest kind of constraint probably at the moment is a little less the GPUs. That was certainly the constraint over the last year. Building data centers is just takes time, right? You've got to have the energy, then the grid turned on. So again, it looks like people like Caterpillar now have a business doing temporary power supply for a data center. And now Caterpillar's an AI play. But, the data center probably is the biggest kind of, construction of those and being able to outfit those and to get through the environmental permits and all of that. That's probably the biggest supply constraint at the moment. And pretty much all these companies, Microsoft, Oracle, they're saying they're supply constrained in AI, which still is positive in terms of the future demand potential. Now, at some point, that will, end up in equilibrium and probably go into oversupply, but, it doesn't look like it's going to happen anytime soon.
I have a final question for Richard on this subject still. Considering the consumers, the customers, the consumers' changing patterns, what is the role of social selling, to boost consumption? How do you see that, such as the ones that are used by TikTok, Shein?
In terms of, sorry, social...
Social selling, because...
Oh, okay, social selling. Yeah, no, I mean, that's... So a few things have changed in terms of the way you would think about selling. So, Mark Zuckerberg built a business that was based on, the best way to figure out what someone was going to do was to figure out what their friends were doing. And they built a social graph, and that indicated what the next video or piece of news you'd want to read. And then a company in China figured out that actually an AI algorithm is much, much better at being able to figure this out. And we had TikTok and, these viral videos. And then again, something that again was invented in China was the idea that, live streaming and the ability of someone, on a short video to be able to influence you to buy something was much more powerful than traditional ways of selling or traditional advertising. So again, we've now seen that. So kind of aggressive data mining, I'd argue from an ESG point of view, in many cases overly aggressive data mining, combined with this new way of selling, has seen companies like Douyin as an enormous, Douyin is a TikTok in China, an enormous e-commerce business, sucked out huge amounts of growth from an Alibaba. We've seen that with Shein, as you say, PDD and Temu. They're just selling in a completely different way, and it's proven to be incredibly effective. And if you throw in free subsidies and a lot of cheap goods as well.
In different ways, right? Because TikTok, they say they are not a social network. They say they are an entertaining platform, communities. But they are selling like, they are being, it's amazing. Anyway, I will pass, to both of you to the final, your final comments, points. Gregor, what we have not been, what we have not talked about yet?
So I want to go back to, I think, one of the first things I said, which is that we believe that the outlook for equities for the next 5 to 10 years will be not as good as before. And so we would advocate looking to invest, to participate in global equities through hedged positions or through defensive, more defensive strategies, mindful of the fact that we have perhaps more volatility in the near future than we've experienced in the past 10 or 15 years, and that valuations we think overall are quite high. So we would encourage investors to diversify away from just, either both the domestic market, but also just, high beta global equities into sort of more defensive and tactical positions in portfolios that are able to provide exposure to global markets, but in a hedged defensive way.
Richard, final considerations?
Yeah, I just come back to profits. We believe that the technology sector will grow its profits faster than any other sector. AI is a key driver of that. We believe that if you can identify companies that are going to deliver more profits than the market expects, they're cheaper than the market expects, and so that solves for the valuation problem in some areas of tech. There's still going to be overvalued areas of tech you want to avoid. And to your point, that there's more volatility, I would see it as just more stock dispersion. And that's because there's a cost of capital, as we all have heard this afternoon. When money is free, everyone's a winner, because no one's going to go bust. The 10th best Indian e-commerce company will still get a check from someone. But now there's a cost of capital and people go bankrupt. The winners really win, the losers really lose. And so I've never seen so much stock dispersion. But hey, if you're a team that can actually identify who's going to win and who's going to lose, that's fantastic for you. So I've never seen so much dispersion in strategy returns and fund returns. And if you're good at this, great. If you're not, you're really getting found out. So again, I would think, please do think about investing internationally. Please do think about, if you're going to do that, diversifying into the one thing you don't have in Brazil, which is a lot of tech, a lot of AI. But if you're going to do that, please pick a manager that actually has some track record of being able to identify winners versus losers than basically just doing factor investing and thematic investing, which is basically just marketing.
This is perfect for us here in Brazil, right? We are just in the beginning of this financial deepening and learning to invest abroad and other assets. Thank you. Thank you very much.